guests.
Good morning. My name is Kelsey Overby, and I'm a second-year executive MBA at Yale SOM, and I'm also on the Student Organizing Committee. It is my pleasure to welcome you to our second panel of the day, Impact Investing and Venture Capital, Aligning Purpose and Profit. Please join me in welcoming our esteemed moderator and speakers. Barr Evan, co-founder and managing partner of Rebalance Capital. Roger Liew, partner at Impact Engine. Enki Toto, senior manager of Impact Investing at Salesforce. And Marieke Spence, executive director at Impact Capital Managers. Thank you.
Thanks, Kelsey. It's such a pleasure to be here. These lights are really bright.
Yeah, right.
We're going to adjust. So we have a really exciting conversation teed up, and we'd love to make this as interactive as possible as well. So towards the end of the hour, I'd love to invite your questions and some of your comments. Just a really quick precursor on ICM before we jump into the meat and the real value here of this panel. We are a network, a membership association of private capital funds that are investing for superior returns, so risk-adjusted market rate returns or better, and meaningful impact, and trying to carry forward that thesis that you don't have to have a trade-off between impact and superior returns. We have about 110 members today. They collectively are deploying about $70 billion in impact-focused capital in the US and beyond, and that's invested in over 1,500 portfolio companies and other strategies. I would also like to give a quick shout-out to two Yale SOM students who will be joining us as Mosaic Fellows this summer, Sophia John and Grace Aronow. I don't know if they're here. Congratulations.
They better be.
Sorry?
They should be.
They should, yeah. If they're not here, then what? Yeah, no, just kidding. So no, they'll be learning the ropes of impact investing at member funds this summer. And we always do this every year. We've got a class of 20 that we just announced recently, and that's our effort to advance traditionally underrepresented talent in finance and investing in the private capital impact investing space. So with that, I would like to turn it over to our panelists and actually ask you each to take maybe up to 2 minutes. So it'll be really quick to introduce yourselves, your name, your role, your fund strategy, and maybe we will start with Barr.
Thanks, Marieke. Good morning, everybody. My name is Barr Evan. I'm one of the managing partners and co-founders at Rebalance Capital. We're an alternative asset manager that's fully dedicated to addressing upward mobility. So we invest in companies that are serving individuals in the bottom 60% of the income distribution and helping them to achieve better economic outcomes. Our first fund is a venture capital fund, which invests in Series A and B companies in financial technology and in workforce technology, which we view as two key drivers of upward mobility. And what that means in practice is that we're looking for companies with at least $1 million of revenue. They've achieved product market fit, they're accelerating their growth, and we're deploying between 5 to 8 million into their rounds as lead investors.
Fantastic, very succinct. Thanks, Barr. Enki.
Hi, everyone. Thanks for having us today. I'm Enki Toto. I'm one of the investors at the Salesforce Ventures Impact Fund. Salesforce Ventures has been investing in enterprise software since before 2010. And our fund was started about 7 years ago to really build on that mission of investing in enterprise software, but really look at enterprise software that has both the social and environmental mission. And so through our fund, we invest in Series A through C companies primarily, sometimes earlier, sometimes later, really looking at companies across education, workforce development, sustainability, financial inclusion, and digital health. Have about 40 companies in our portfolio to date and are excited to keep investing.
Awesome. Roger.
Good morning, everybody. We also have 2 active interns who are SOM members, and one of my colleagues is a recent SOM graduate. So my name is Roger. I work at Impact Engine. We're a women-led and majority-owned investment firm based out of Chicago. We invest in early-stage venture all the way to growth and buyout in 3 impact areas. That's environmental sustainability, economic empowerment, and health equity. We also, somewhat uniquely, we also invest in other funds, other impact funds. And so in the growth equity side, we've been sort of catalytic capital for several funds, like not quite anchor investors, but early impact investors into first-time fund managers.
Awesome. So before this panel, we sort of shared some interesting stats and some, you could say, kind of like scary stats, but there's opportunity, right, and challenge as well. Barr, maybe you can talk a little bit about capital formation. Is it really, is it a hellscape right now? What do you, people have talked about how challenging it is. So what are your thoughts on capital formation as a VC?
Sure. And so to clarify, so what we mean by capital formation is, of course, companies are looking for capital from venture capital firms, but we as venture capital firms, unless we're so lucky as to perhaps be at a corporation or another entity, we also go out to fundraise from limited partners, as we've heard, which are the asset owners, the foundations, the pension funds, and so forth. And so, as I think many of us are aware, there has been a bit of a pop in the venture capital bubble over the past 18 months. And some of the stats that Marieke was referencing are that in the first quarter of this year, closes by venture capital funds are down by about 80% versus last year. And what we're seeing is also a big concentration in where limited partners are still allocating. So about 83% of capital is going to just 7% of fund managers. And so many fund managers are not succeeding in raising. So what does that tell us, and what do we think about the prospects? So, a few comments I would make are certainly the problems in the VC space did not start in the impact subsegment. But what tends to happen when a big market is disrupted is that there's a flight towards familiar and to what LPs know. And in a way, it's a safer bet to go back to your previous fund that you've committed to already, even if it's not performing as well, than to say now is the time to commit to a new fund. And so, unfortunately, that's what we're seeing. Having said that, I think there's also like a lot of good long-term tailwinds for the sector. And it's a bit simplistic to think of there just being one cycle right now. Inevitably, there's many overlapping cycles happening at the same time. And as we've heard, there is still a long-term macro secular trend supporting impact managers. And so I do think that over the medium term, we will see that trend continues. In addition, in terms of timing, it's always complicated to time cycles, but the private sector tends to have slightly longer down cycles than public because things just take longer to price. Companies can sort of stagger along for about a year before they actually get that down round, so the signs of problems can take longer, and therefore that drags the cycle out. On average, although it changes, on average a down cycle in VC can be about 2 years. We're about a year into this down cycle, which means that we would expect there to be some pain still to come, but still there's like reasons to think that 2024 should be a better environment. And then the other thing I would say about fundraising is limited partners are not a uniform block. So again, we heard in the previous panel, endowments and foundations will behave very differently from individuals, will behave very differently from pensions, and so forth. And so I think what is promising is that you're still seeing folks who are mission-driven, who are saying, regardless of what the macro situation is, the mandate that has come down from the board is to start a new impact allocation. And that is like really exciting greenfield opportunities for impact funds. And so I think when you're fundraising, you're thinking about, even if the macro environment is looking one way, what are the specific pockets that I can target, that I can fundraise from? And frankly, when you're fundraising, this is always true. You go to people who already get your story, already aligned with what you're doing. That's the best place to start. And so I think that's the advice that we're taking and that we're giving others as well.
So it'd be safe to say you think there are more like impact-curious allocators out there who are willing to take a meeting?
Yeah, for sure. Yeah, we still are experiencing that when we present our fund, people are saying there isn't enough people doing what you're doing. We are getting pressure from our stakeholders to expand our allocation. Again, we heard, I think there is a perception that there's a lot of opportunity in the environmental side, less on the social side, which is where we play. So that's been helpful. So yeah, it's not difficult to get a meeting at the moment.
Roger, I'm kind of curious. So you've got several funds now under your belt. So as somebody who's kind of been to this rodeo before, what are your thoughts on fundraising today for impact VC specifically?
Well, I think a lot of what Barr said is definitely true. I mean, I don't know. I hadn't heard hellscape, but certainly, for a while we've been hearing denominator effect. That's like because your public portfolio is down. That means you skew too much in your private portfolio. So I can't allocate any more money to my private portfolio until the public markets come back. And that probably started last year sometime. Mm-hmm. And then I think, in the previous panel, they mentioned about track records. I think that's what you see is like people kind of retrenching back to like, what can I quantify? Yeah. And I think the other thing, which is interesting, is, we were joking about wisdom. I was working through the first kind of, the 2000 crash and living through that. And then, the 2009 downturn. And actually, one of the things which is interesting is those of us old timers are arguing about, is it more like 2000 or is it more like 2009? And the big difference is like 2000, it took like until 2008 before things got back. And if it's 2009, then next year we'll be back in business. And I'm an optimist, so I'm like, there's nothing structural that says it needs a long-term correction to address. And I think for impact specifically, there's so many opportunities. I mean, the problems don't go away. And what I like about these times is like, you can really focus on investing in quality businesses that have a reason for being, not just a reason to raise a future round. To me, that's like always it's very clear now, the businesses that were like, you are dying if you don't raise more capital. Right. That is very stark right now.
Yeah, I think it kind of goes to some of the points that were raised in the last panel around this sort of, if we believe in that kind of collinearity between financial return and impact outcomes as well. I mean, it's maybe some of these things that were considered externalities are now kind of just becoming more priced in, right? Sort of material risks, and so you kind of can't avoid them. A smart investor can't avoid them, and we see more funds that don't even brand as an impact fund. There's a climate tech fund that they may be bucketed, or sort of an allocator might say, you check that impact box for me, even if they don't kind of carry that water within their fund as far as impact measurement or management, or sort of really wearing the mantle kind of more explicitly. Enki, turning to you, kind of other aspects of this market, which are interesting and sort of uncertain, valuations, right, and sort of diligence, the return of diligence. Can you talk a little bit about that from what you're seeing at Salesforce Impact Fund?
Yeah, and it's we have this really unique position where we not only can see what's happening in the impact world, but we can also see what's happening in the more general software investing world because of our partners on the Salesforce Ventures side. So, I mean, overall, obviously you have hype cycles, and we'll talk about AI later, but AI is in a hype cycle, and those valuations are not going down. They are, exactly what we saw back in 2021, 2022, where companies were raising at exceptional valuations with very little revenue. Barr mentioned the $1 million to raise a Series A. We also aligned to that, and I'd say in the last couple of years, it was confusing as to what you needed, particularly for founders, in order to raise a Series A. The benchmarks that we sort of align founders to when it makes sense to raise your A, your B, your C, had sort of fallen apart and fallen away, and instead people were raising because the capital was there and very available, and the valuations matched it. I think now, outside of AI, I think you're seeing more and more flat rounds, so lots of extension rounds, companies not necessarily wanting to raise a new round because, frankly, they haven't met those metrics and they haven't shown that progress yet in order to justify an up round. And if your valuation last year was, let's say 50x your revenue, it's going to be hard to raise again at a higher valuation when all you've done is, even if you've had 100% growth, that's still a lot to make up when now investors are investing, it depends on the sector, but let's say 10 to 20x, where before they were comfortable with 50 to even sometimes 70x multiples. So it really, I think it's a good thing for the market personally, and welcome the group's thoughts here. I think it's helpful for founders because these are projections that are meant to sustain you and really develop a really good business. A lot of companies, one idea that was floating around is that you raise a lot of money now and therefore you don't have to raise later. But that didn't necessarily happen, as a lot of companies are now coming back into the market because of not having any cash remaining, because they were now also spending cash with a new forecast in terms of what their capital availability was. So I think it's a good thing. I think we're stabilizing again. On the other side, what you also see when there's not a hype cycle and as much access to capital is that investors are also now asking for more data and asking for more information on the company and really doing the work. I think in Impact in particular, those founders were always available for questions. So I think we didn't see it as much of a hype cycle. I think Impact remains fairly stable, but definitely was part of the last few years. But I do think that this return to really digging into financial models, really digging into cash burn and sustainability of the business when investors are investing, to make sure that can you flip to cash flow positive in case you don't have access to capital in 2 years, or is your business essentially dead? Earlier stage companies will always need more capital, so obviously this leans more towards the Series B, or even if you're an A trying to get to a B, C company. I think if you're not thinking about cash flow positive forecasts, and if you're not thinking about how do I sustain myself for 2-3 years, because those funding cycles might be at a low for a couple years, I think you're doing yourself a disservice to think that funding will be the same as it was in the past. But I also push investors for us to keep doing the work of really diligencing and understanding and learning about the companies we're investing in, so that we can also better help them down the line. Because this is a great time to really get to know those companies and dive in and see if you're a good partner for each other too. I think diligence is sort of like when you go to a job interview, right? That's what you're trying to understand. You're trying to understand everything there is, so that this can be a long partnership. These partnerships are 5-10 years long sometimes. So you definitely want to make sure you know who you're partnering up with. Any thoughts from you all?
Feel free to jump in. Any thoughts on valuations or sort of negotiating with companies?
I think, I agree with a lot of all of it. Last year there were times when people are like, you have 2 days to decide if you want to get in on this round. I'm like, no, it just is not possible.
Without a financial model.
Yeah.
no information.
There was a slide on the 5th page of our deck which had a summary with the next 7-year projections, but no history.
And it went like this.
Yes, of course. And so I think the one thing I would add to that is, for us, the impact diligence is sort of really kind of part of every phase of that diligence. For us, we try to develop the thesis as we go on okay, how are we going to quantify this? What is that theory of change for us when we make that investment? And so I think the beauty of this additional time is that we get to have those conversations and actually get real aligned with the companies the founders we invest in, because in a lot of cases we're maybe one of the few investors that care about that side of their business, and so that's a very exciting part of the diligence process, which I think this newfound time. And the other thing I would say is I feel like right now we're also seeing certain funds kind of take advantage of companies, meaning it's the same companies that pumped way too much cash into the company now is coming back and giving them terms that are very I don't know, it just feels bad. These are you helped guide them to this point, and now they're going to lose a lot of their company because of actions the board kind of steered them towards. So I'm having some moral conflict on that.
I think we also saw that with the SVB crash too, right? There were certain investors that maybe pushed a lot of money into companies, and what we heard from our portfolio companies is that they were silent. They were not to be heard from during, a really, the founder sentiment that weekend was was so scary, right? Imagine like not being able to pay cash flow on Monday, even though you have cash and you kind of don't know what to do. So I also think like when hard times come, you also want to make sure that you know the companies that you're working with, and you're also willing to help them and step up.
I'm kind of curious to just kind of teasing this out a little bit further. I mean, ICAM's about to come out with some research. We're going to do a little soft plug for this, but in about 2.5 weeks on an analysis of 230 exits across our membership for the past 10 years, looking at self-reported financial return and impact, so both of those dimensions, and also digging into kind of what the exit landscape looks like. We're looking at IPOs, SPACs, strategic buyer, financial buyer, and one of the things that's starting to emerge is you've got allocators who are looking for that stickiness of impact, or maybe there's a bigger universe of exit opportunities now for us to find a mission-aligned exit option. And maybe that's helping to establish some sort of impact premium for an impact fund manager. On the flip side, when you're looking at portfolio companies, do you think that gives you a competitive advantage, like in a bake-off, like with other, do you find that mission alignment is helpful?
I mean, speaking for us, I think oftentimes we're one of, a few impact funds that are part of the business. And what we've heard from the companies that we partner is they really like that impact side because we look at things very differently. And also the spaces that we're looking at, we can provide more advice to them or notice things. For example, we have a fintech company that when the IRA came out, all their other investors are really focused on fintech because we have a climate lens as well. There's actually ways for them to plug into the climate world, even though they're fintech, and they can leverage their fintech platform to really, monetize on this IRA. So I think that having that wide scope in also areas that are going to be adjacent to what they work in becomes a real value add.
So that goes to the additionality piece, I think, also that we heard earlier this morning, which is really important and one of the things that we focus on too at ICM. So Roger, tell us about the state of play in impact measurement and management, right? So it's like there's this plethora of new software platforms, tools, frameworks. It's busy out there. It's interesting too because we've got profit and purpose. I think in the headline of this panel, but we don't mention impact and we don't talk about ESG, right? So those things are not mentioned. So what if every founder is mission driven and is purpose driven? Kind of what makes an impact investor an impact investor, right? Is IMM impact management kind of a prerequisite, or is it if you're labeled as such by an allocator that's good enough? Like, what is it?
Well, yeah, there's obviously an opinion, but I think for us, I think what I alluded to before was like having, there's a lot of literature out there, right? Like IMP or having alignment of your process with the impact management project, the 5 dimensions of impact, that's a good starting point. I think the other, I think quantifying impact is very important for us, and actually doing some type of regular reporting, because, at the end of the day, I think what you measure should have relevance in terms of like what actions you take. And I think the evolution of this is actually, for us, it's actually gotten a lot simpler, because sometimes you can come up with the best impact metrics, which capture like every element of what they're doing, but it's very hard to generate. Then they're not going to look at it on a regular basis. And so our goal is like the company is motivated by the measures we agree to on the investment side. And I think as investors, I would think you also should have a thesis on like every company you invest in is like, why is this company impactful? And be able to defend that and actually be passionate about it. There's one of my partners came up with a term called impact whisperers. And this generally applies to like later stage funds where they're kind of embarrassed to say they're impact because they're afraid people will think they're concessionary. And I think our goal is to try to get them to be like, actually be loud and proud about being impactful. And that could generate alpha for them.
Curious, Barr, how do you think about impact measurement and management from where you sit?
Yeah, sure. So, I think as Roger's saying, there's the ideal, and then there's the maybe messy reality. So, in an ideal world, what we would see is some academic literature that backs up the intervention that the company is looking to implement. It may not be a one-to-one translation, but certainly indicates what the theory of change is. I've used that term now. So, a theory of change of how right now and in future the model is going to evolve. And then also legal reporting requirements. So when we make a lead investment in a company, we always have a side letter in place which requires, based on an agreement, a discussion, what are the most material impact metrics that the company is going to report and how they align with the business model. And then finally, I think what's great is that now we're also seeing an increasing movement to actually reporting on the demographics of the users, the employees, the beneficiaries, all the stakeholders of the company. So we have experience where companies know they're delivering a good product, but they don't actually know who they're serving. And so we work with companies to do that. I think, though, as an early stage investor, you also have to be realistic that you're not going to get the same reporting from every founder. For example, if you're working with, as we do, often with B2B companies, so they are serving other corporations, they may not have great visibility until the end user that their product is ultimately looking to help. Another issue that comes up in reporting is that ideally you would like every company to report the same metrics, so you can do a sum function and get one number and report that to the LP. That doesn't happen, or if it happens, it tends to happen in a way that I think is kind of unhelpful. It'll be number of users, right, which doesn't mean anything at a portfolio level. So I think again one of the panelists on the previous panel said these things are hard and they take time and they're iterative. And so I think that it does actually ultimately come back to a conversation about intention, about mission, with the founder or with the fund manager if you're doing that diligence. And then you see incremental progress on the reporting over time towards that end goal that we're all working towards.
Just to follow up on that, is there a stage at which is it maybe pre-seed seed? Is there does you all have an opinion on whether there should be a grace period, sort of pre-revenue, shouldn't have to measure impact or something like that? Because we've definitely heard, if you're a really early stage VC, you're sort of you're working with small teams, they're hair on fire all the time, they're trying to work towards commercialization and sort of product delivery, getting to market. How do you think about that, right? We love to, again, carry the water for you don't have to have a trade-off between impact and return. There's a cost to measuring impact. It takes, right? There's time. It's hard. You have to figure out how to ask, whom to ask, scrub the data, who's accountable for that over time. I'm just kind of curious if you think that there's a threshold and where you would put that threshold. Enki, you can jump in too.
I don't know that there's a threshold. I mean, I think by Series B, if you haven't been thinking about what your impact is, you should get quickly to it. I think at the seed stage, companies are still trying to actually figure out what their product is. And so what we've seen, and I think what we get excited by because we're also impact investors, is companies that are building their product with impact in mind, right? And so for many impact companies, it's not that the impact is secondary, where it's something we need to measure. It's very much built into the product of here's who we're serving and here's what we want to happen to them, right? Here's the outcome we want. And oh, by the way, in order to do this, we're building this product. And therefore, there are certain metrics that are not necessarily impact. They're business metrics. They're metrics that you need to know if the product you're selling is actually working and doing what you want it to do. So those are the types of companies where that impact is just inherent in their business model that we get really excited about. But in terms of I answered a different question, but in terms of stage, I think, there's companies that also come to impact later, right? That it starts getting built in. So definitely by Series B.
Okay. I think when we invest in pre or seed stage companies, we have an impact thesis, which has metrics that we've defined. We've also learned over time that you need to evolve those metrics as as the company figures out a product market fit. But we don't really let them off the hook and say well, you said you would give us these numbers. They could be bad, and we didn't know why. We didn't realize the impact that we anticipated. And so I think there's been we have 65 companies in our active portfolio. I think in 2 separate times we've chosen not to follow on because the impact was no longer there in later rounds. The company was doing fine financially, but it was like we just couldn't say to our investors that the impact that we anticipated was actually being delivered.
So I know we want to open up for questions, but I want to really quickly ask Barr, because I feel like we have to talk a little bit more about AI. So if we don't check that box in this conversation. But so again, you're working on fintech, financial inclusion, upward mobility. Is really quickly, like, what's your hot take on is artificial intelligence developments, ChatGPT, is this going to be a net positive for your thesis, impact thesis, or not?
Yeah, it's going to be a net positive. Is the answer. I think, like Enki's saying, we're not investing in like ChatGPT forward, AI forward companies because many of them are hopefully doing something more like infrastructure level for the overall technology and less specific to our sectors and use cases. But our expectation is that the portfolio companies that we invest in, whether it's fintech, whether it's workforce, are going to get a boost from this technology. I will say AI has been around for decades, right? Like Google is like an early AI, right? This isn't like a black and white jump. We now have a big advance in what we can do with large language models, what we can do with like generative technology, where you get a response to a query in a more user-friendly way. But net, what it does is it should lower costs, which ultimately for funds focused on underserved populations is very exciting, because the barrier for many business models looking to serve individuals on the lower end of the income threshold is that the cost to serve or the cost to acquire customers is prohibitive. So even if you can eventually deliver the product, to get in front of the customers is hard. And so ChatGPT should help. And then of course there are the same warning signs around AI and around use of technology as always, right? So we know that a big danger is that they carry forward existing biases when you're looking at an underwriting model or when you're looking at who has the right background for a job, right? If you just throw AI into the mix, that can be dangerous. So that's, I would say it's AI and the current iteration of it is going to increase both the good and the bad. And so we have to be, even more worried than we were before, but also excited about the prospects.
Awesome. So given timing, I want to make sure we have the chance to let this awesome audience ask some questions of the panelists. So if anybody has a question, please. Get one here.
Hello. Okay, great. Thank you so much, everybody. My name is Liew Bartlett. I'm a second-year full-time MBA here at the School of Management. And my question is kind of related to one of the earlier points that the panel was discussing around the current economic situation today and the impact that has on future fundraising, et cetera. So I'm just curious, what kind of advice are you guys providing to your portfolio companies that are existing today? Because I've kind of been hearing 2 vastly different camps. One, more prudent, be very, very diligent in terms of your own budget, push towards cash flow positive, cut costs wherever you can. And then the other side, I've seen some people even talk about like leaning into it, taking this as an opportunity, like with the big tech players, cutting their particular resources, maybe cutting their marketing costs, and then these kind of smaller, earlier stage companies put more capital into it, more into marketing, and really try and capture more of the market at this early stage. So I'm curious, what are you guys telling your portfolio companies? I'm sure it changes on a company-to-company basis, but I guess if you could sum it up, what's the general kind of sentiment? Thank you.
Well, I think it's the first one mostly, because I think if you raise, it's going to be expensive. Like it's going to cost you more, or you're going to lose more of your company, or something like that, right? I think on the other side, for companies that are in a position to hire or invest in resources, it's actually kind of like a golden age. The last 2 years, you couldn't hire anybody because you couldn't compete with Meta, Google, Amazon for salaries. And then now it's like, all of a sudden people are willing to entertain working for a startup again. And so in that sense, like the companies that are positioned to grow, I think you have the capacity to do that. And in certain areas, I think AI, right, obviously is one. I think companies that can convincingly adopt AI to accelerate whatever they're doing, I think that's moving very quickly as well. There's companies in our portfolio who are moving very quickly to either get more efficient, improve their processes, scale faster, like for content generation, things like that. We do see big opportunities for them to actually really kind of level up.
I think one other thought is just around how you're scaling up. So yes, like if you're in a growing market and you need to seize that opportunity, absolutely do it. But do it responsibly, right? Do it with data-driven reasons for hiring X number of people. I think what tends to happen is that you put a hiring goal and then you hire for that, but then your metrics might not necessarily match that. So I think consistently reviewing your teams and making sure that you're responsibly growing is something that should be prudent for any company, regardless of stage and whether you're in a growing market or not.
It's funny how people forget that. Like last year, that was like a very unpopular conversation to have in the boardroom.
Yeah, is your sales team performing? Yes or no?
Yeah. How can we quantify that? Can we see the pipeline?
By person.
Yes, exactly.
Thank you.
Hi, thanks so much for this panel. It's been really, really informative and helpful. I'm Andrew. I'm a social impact MBA at Boston University. My question, I believe all of you talked about having economic growth being a component of the companies you're looking for in terms of impact. And I wonder if you could talk a little bit about some of the impact measurement you utilize to try and prove a theory of change associated with promoting economic mobility to lower income populations. That'd be great. Thanks.
Sure. I can speak to that. So again, it varies company by company, of course, but we certainly look at increases in income as one area. In workforce companies, we also look at whether people are gaining credentials that are then going to set them up for future success across different career paths, and what our role is, going back to additionality and actually bringing those about. On the financial inclusion side, obviously, we're looking at savings rates. We're also looking at resilience, and so we work with insurance companies. And so you may not see an increase in savings, but if we know that people have a safety net, if something goes wrong, that actually is a massive driver of social mobility, because then people feel that they're able to take risks, to invest in education for their kids. That's a specific metric we look at. And then a very common one, which is sadly prominent in the US, is looking at people who are able to pay down high-cost debt. So a lot of people borrow outside the formal financial system. So can you move them from irresponsible sources of debt to responsible ones? So again, I would summarize, there's no one metric for observability, but we definitely look at a product by product area.
Cool, thanks.
Oh, there's a question.
Hi there, I'm McCall. I have a question around, as fund managers, making sure that your companies are well capitalized. Because while we're addressing the needs of users who might fall in the impact, maybe they're underrepresented in the financial markets, health markets, education markets, their expectations from the companies and the products are no different from other users. So they're not expecting any less from a mobile app experience. They're not expecting their app to have less cybersecurity. They're not expecting their marketing to be subpar. So essentially, the sort of capital that you need for a company that has an impact mission is no different than the capital that you need for one that does not. So this notion, and what I experience, is that people think somehow you need less money, or that your user will be okay with a subpar product or experience.
Fascinating perspective. What do you think?
I mean, from our side, I'd say most of our companies raise at similar like round dynamics as other types of, a more traditional software company. We also only invest in software companies, so they definitely are much more aligned. So I haven't seen that actually in our companies, but definitely agree with you that their customers are by no means taking a concession on the type of product that they're getting from an impact company versus any other company.
Yeah. Again, I don't know your specific experience, but if I can relate it to maybe what I've seen is that I think there is an unfortunate tendency when investors view themselves as mission-driven. The flip side of that is they might say, oh, my resources are so precious, I need to spread them out over mission-driven companies, and therefore, I'm going to give out less. I'm going to hope that you can make do with less. And I think what, organizations like ICM and I think the investors that we represent are rejecting that paradigm and very much believe that impact-driven companies, as you say, right, need just as much investment. You need to hire talent to compete in the market. You don't want second-rate talent either. So, if you're meeting a funder that's telling you, because it's mission-driven, I can put less in, then I agree that that's not a formula for success for your organization.
I think I would add that also possibly what people are saying when they think you require less capital is maybe they think the opportunity isn't as big. And so I think part of what we work with our companies to do is to actually lay out, why do we think the market is as big as it is? Because at the end of the day, the amount of capital you need should pencil out in the model. And I think, when people talk about for the diligence process, we're trying to mathematically figure out okay, well, what do we think the amount of capital is, and can we get alignment with the founder on that? Certainly in investments we've made in the past, especially in the early stage ones, companies occasionally squander capital. They build something, they over-engineer something, or they hire a world-class a software development team to build something that you probably could have just bundled together some no-code platform. And so I think the amount of capital you need, I think it's incumbent upon the founders to really convince your investors and actually find investors who you see eye to eye with on that. Because otherwise, that's a very painful process down the road.
Any other questions? I'd love to, do I see one? Okay. I'd love to quickly ask you, Enki, about ESG, because I also feel like we can't have this panel without talking about that a little bit in the context of, what it means to be an impact investor. So how do you think about that? And is managing for ESG sort of just not within the realm of, again, early stage VC or VC investing when you have an impact lens?
Yeah, I think from our side, it's great because we actually, I see both sides. I see our early stage companies, and I also see the Salesforce side as a large public company. And so from the Salesforce side, we've always been really pro ESG reporting. Public companies continuing to disclose a lot of their ESG metrics, et cetera. Our former CFO was on the board of A4S. So we've been very forward in that regard and have always shared our own stakeholder impact report, which as a shameless plug is now available. And so public about just what we're doing as a company around ESG and really aligning to all those different disclosures. I think from the impact side, we actually don't talk about ESG necessarily in our companies because that they're a little bit different. They're really focused on that impact, right? And I think ESG and impact kind of get overlaid, but I think of them as two separate things. An impact company is one that's mission driven, is driving towards having those specific outcomes, however the fund defines it. And ESG is more get your house in order as a company in terms of making sure that what you're doing in the world is actually not a net negative, right? And how do you make sure that you can do the best positive thing that you can as a company towards that and really disclose around that. But I don't know if I know that I feel like this is a topic that comes up a lot, and I feel like there's weak definitions of what it is, right? Everyone has their own interpretation. So
Yeah, I mean, I always like to think of it as, and it's not an ideal, it's not a spectrum necessarily, but sort of ESG being how the world is affecting your company, irrespective of what the company's in the business of doing, and then impact is about how your company is affecting the world. It's kind of a nice thing to say. It's more complicated than that, clearly, right? But I think that's kind of going to that. What are those risks, and also not being too preachy around impact, right? You can create impact by making the supply chain of a large public company a lot more efficient or ethical, right? Like there are things you can do, and so not being too precious, right? Around kind of how we think of that too. Roger, any other thoughts on ESG versus impact?
I mean, it's kind of an and for us because we adopted kind of the SASB materiality framework for ESG. And it basically, like by industry, it tells you which factors are important for the companies. So for software companies, some obvious ones are like, do you have a privacy policy for your customer data? Do you have appropriate cybersecurity risks? Which most people don't think of as traditional ESG, but it's like, it's pretty bad, right, if you disclose your healthcare data of patients. And so that helps us for early stage investments kind of checklist that, it's a risk management exercise.
Right.
Are we assessing these things? For later stage companies, we actually help them provide that because other investors may want that type of ESG rigor in their company. So we do think it's additive, but by no means is like, an ESG investment, an impact investment.
Right.
Can I ask a question to our panel? We had a CEO summit a couple months ago, and one thing that we talked a lot about was actually ESG hushing or green hushing, and we saw this where companies are now not wanting to be public about their ESG and the fact that their impact, because, and I think you mentioned this before, they view it that they'll be viewed negatively in the public markets with everything going on a more political level with ESG. So I'm curious if you're seeing that, particularly, Roger, because you have later stage companies as well in the portfolio.
No one is. That hasn't come up in terms of like a concern. Because I think you can do it without. You're right. I mean, you can do it without talking about it. And it's, I always find the whole ESG debate, the whole ESG labeling debate funny, especially with Texas, when you think about like the amount of wind power and the amount of sustainable energy that's being generated in the state of Texas. I'm like, I wonder if they know that.
Yeah.
Like those windmills actually produce power, or those solar panels actually are generating electricity. It's like, it's kind of obvious, right, when you're driving through Texas. In Iowa, like when I go west from Chicago and you drive through Iowa, the entire state is covered with windmills. And it's like, but these guys know, right? This is just cheaper energy, and it's good for us. So it's weird to me. I can't even begin to understand. I mean, that's a whole different topic, right?
We got a question here and one here. And how are we doing on time? Because I want to make sure we're good. Okay.
Hey everyone, Nick Liew, first year MBA. So I think there's a lot of focus in VC in these sort of traditionally thought of impact areas like clean tech or financial inclusion. Are there any areas or verticals that you think are not traditionally thought of as impact categories that you think actually do fall under that umbrella?
I mean, well, I think this does traditionally, but one thing that we've been talking a lot about as a team, I think in impact, you kind of have to go where the problems are, right? Like impact is, there's huge problems. I also think that's why impact investing is such a huge field, because we have a lot of problems to solve. And so where there's problems, money will flow, right? And we need to develop solutions. And so when you think about markets, right, where the biggest problems are, that's a big market. But I think one that has definitely come to light more recently is like the care economy. So everything from cradle to grave, essentially. How do we support new mothers to how do we support our elderly population? And I think there's more opportunity for investment there.
Yeah. I think there's a growing debate about gov tech as like an impact sector. So it's cross-cutting from a specific impact outcome perspective, but what is the role of private companies in sort of bringing efficiency to how people access benefits? Is that sort of taking out the role of government, which should be there? Is that giving too much power to private corporations? But there's been a couple of companies that have made real success with food vouchers and other credits and sort of making them more accessible. And then the other big question about that sector is it any good to invest in? So the government, it's a massive TAM if you can actually capture some of the flows that are going through it, but it's very difficult customers. And so I think there's an open question about that segment right now.
Thank you.
I think we've got one down in the front as well after. Yeah.
Hi, thank you for your sharing. I'm curious, how has impact investing changed within VC since the introduction of the UN SDGs, and how do you anticipate it changing until 2030? Thank you.
Hopefully there's more of it, a lot more. I always feel like the problems impact companies are solving are the problems worth solving. Maybe that's a slightly controversial, in terms of do we need more cleaning delivery services, right, or more dog walking services in the world? So I think there's an allocation of capital, and I think more capital should be allocated toward solving kind of genuine human problems.
Yeah, I don't believe that it's going to disappear as a concept. This discussion of everyone's going to become an impact investor. I think every strategy that is raised, on the one hand, is looking for financial returns, but on the other hand, is expressing some kind of broader view of the world, some interest of the team in what they like to invest in, whether it's growth equity or whether it's real estate. And so I do hope that impact is not viewed as being quite so different as a focus as it is right now. But certainly, we're actually earlier talking about diligence, right? I think the way that impact investors do diligence is fundamentally different because of what they care about and a certain view of how companies, stand in the portfolio. I perceive often a high level of care for the founders and for the outcome, unless, if this works, great, and if not, it doesn't. So, I think it will remain a separate community, a separate, way of investing, even if hopefully it's not viewed as quite so separate from other types of capital.
Yeah, for us, I think what we've seen in the last at least 4 years that I've been on the fund is, I think you do see more of those, just a traditional investor that does not have an impact lens coming into impact deals. And if you look at the last couple years of fundraisers, you do see those investors in those deals. And I think that's, that started in the last 2 years more and more. And I think that'll continue because, again, everyone's looking for financial returns across the board. And what you'll see is that because of these huge problems, there's also a lot of capacity to make a lot of returns there. So, but I do think that having impact investors around the table is equally important because they have two different value sets, and it makes a really good cap table and board discussion.
And I'd really like to double down. I hope it stays distinct, and I hope the bar continues to rise on what impact means, because I can kind of see it'll be like ESG, everybody will be like, oh, you could raise capital if you're called an impact fund. Well, we're an impact fund. And we're not going to produce anything. We're just going to talk about how great the impact is. And I think that would be really disappointing for me if that's what happens. Right.
Just really quickly, I think also the moderator's prerogative to answer your question about the SDGs. Not to throw shade on anybody who has them in their deck, but we see a lot of prospective members knock on ICM's door, and they might share their scrub deck with us. And some people, we hit SDG 8, 5, and 2. And I'm like, well, do you hit them in a good way or a bad way? Right? It's become so ubiquitous. It's more, and it goes to your point, Roger, about sort of marketing, right? So is impact investing mainstream? Maybe not yet. Marketing of impact investing has gone mainstream, right? And so when we think about those numbers of trillions of dollars, and we look at this explosive growth or exponential growth, how much of that is public markets? Because you might defensively argue that it's difficult with the structures and incentives in public markets to really to do impact. There's sort of short-termism, right? That's kind of inherent in the way that the rules are played now. So the game is played now. And so like you cut out that public equities piece, and then you look at private equity, and then you look at, how many of those players are measuring and managing their impact in any way, or like sort of outlining what they think their baseline assumptions are. Take it a whole billions of dollars to cut out of that. So when you actually get to like where we are with impact and sort of how people are, the funny thing about the SDGs is that some people will dig into them. They have, if you look at them, there are indicators and metrics that are suggested, right? Sort of you go a little level deeper. Some people I know, like Bain does a really good job. Bain Double Impact uses that. Others may not even be aware that that they can do it. It's just a marketing tool. Yeah. So, unfortunately.
I think the SDGs could also be helpful, and just like we're not there yet because I don't think enough investment has actually been put in. But as we get closer to those end goals of just where do we need, like where are we over invested from an SDGs perspective, versus where haven't we put in that level of investment? And I think it's nice to have that like broader framework just to do those quick metrics. But overall, I agree with everything that was said.
We're at time. Please join me in thanking these three amazing investors.
Stay here.
I think we're heading in.
She wanted to take a picture, right?
Right there, yeah.
Thank you all so much. I think we can take our second break, our lunch break for 1 hour. Thank you. Very great.
I know, it's like, because they're like,